Hi, welcome to Market Minute. The Ohio State Oregon game, what a great game. Unfortunately, the Buckeyes lost, huh? I think the Buckeyes really needed this type of game. They didn't haven't played anybody, haven't played with a sense of urgency at all, and this is really good for them. I think Ohio State and Oregon will meet at least one more time in the Big Ten championship game, but maybe again in a national championship game. I think these are the two best teams in college football, personally. So we're looking at the election risk this week and some of the downside as well. And then we ponder: Are we melting up? Is this a melt up that's occurring in the overall market, or are we just overbought? And then we got a great swap, trade down of CrowdStrike and in the ASML. So the stock market, what's going on with the election? So it looks like Trump has a little bit of a lead. I think the market's probably discounting a Trump victory. That's what we can surmise from what we read and hear. And the risk is if Harris gets elected, that the Trump tax cuts go away and taxes go up on everybody starting 2026. So everybody benefited from, or most people benefited from the tax cut, particularly the people at the low end. People making 15,000 to 50,000, they saw their taxes drop, so they got real growth in their personal income. And then the other issue is we need to fix the border. I don't know what's going through Harris's mind, what she's going to do, but if she's going to continue with the Biden policies, this is a big problem. Trump will fix that, so we think that is a big positive if that occurs. The border causes a lot of problems, not only crime but inflationary issues. We have to pay a lot of expenses for these people coming in. That's a lot of people. So here in Denver, we're seeing the rents go up quite a bit. And then the chatter about Elon Musk coming over and heading up a efficiency commission to make things work better, cheaper, and take out the fraud out of the government, fraudulent spending, would be really, really positive. There's probably 500 million to maybe even $1 trillion that could be cut out of that budget. And again, that could be viewed as a risk as well in terms of Trump's elected, that you have this spending that's going away, and that'll hurt the overall economy. But long term, that's a big, big positive. Ramaswamy may be heading up the FDA. That's extremely intriguing, both on the business side but also for patients. So really good for drug stocks if that would occur, and for patients. Um, so probably the biggest bull that I know out there, and I've been following his work for 39 years, is Dr. Ed Yardeni. He does some really good work. He's all seems to be always very bullish. He's a little bit less bullish recently. So he's looking for 8,000 on the S&P 500 by 2030, and that comes out to about a 6% annual rate of return. And if you apply a 15% standard deviation and then look at the risk in the overall market, so here's Yardeni's work on valuation as well. So you see we were at 25 times back in 2000. That was the high that we've seen in terms of valuations. We're currently 21 times. Obviously, we came off a big low back in 2009, down close to 10 times earnings, all the way up to 22 times earnings. So a lot of multiple expansion over that period. So if things normalize a little bit, interest rates go up, to get a 10% return, there's some downside risk in this overall market. So what we're watching very closely is the yield on the 10-year Treasury. So that's the yield that the Wall Street folks value the stock market off of. So if the 10-year Treasury goes up, that decreases the value of the overall stock market. So we've gone from 3.6% to 4.1% since the Fed's cut rates. If they continue to cut and the 10-year Treasury continues to go up, obviously we're going to have a big correction, if not a bear market. So the technicals have been really strong. So going back to November of last year, we had a big move up, through the 200 day and up to a very, very strong trend line. We're back up to the high of that trend line, a very strong movement in the overall market. So we're at the upper end of that big, strong movement. So the stock market is overbought. And the thing we think about is, are we melting up? Meaning, is the market just going to go up on thin air and then ultimately crash down like it always does on a melt up? Or are we going to see a correction occur? The correction should occur, any day now. We're in the zip code of this correction, if that's what is to occur. Otherwise, if we see melt up into the end of the year, that's not going to be very good for next year. I always hate buying things knowing that 3 or 6 months down the road, to get a little bit of return now, but to be lower 3 to 6 months down the road. So that's kind of what it feels like to us. Would really welcome a correction in the overall markets. So kind of to answer the questions, if we're in a melt up or just are we going to have a normal correction, we look at the investor sentiment. And the investor sentiment, it's 2.3 times bulls to bear. That's really high, to get to, the negative side of that, where we were back in November of last year, there was 50% bears in the overall market. So we're 2.3 times bulls to bear. The correction is going to occur any day now, any week now, anytime soon. The correction will occur, or otherwise we might melt up. So it's not fun to see a melt up because you know what's on the other side of it. I would love to see the market down around 5,000 or 5,200 on the S&P to improve the longer term returns, right? But also hit that 200-day moving average or support line, and then set the markets up for a strong move next year. So energy stocks, we've been talking about this for a while. We've been positive on the group for over a month. We've took advantage of a very nice move up in these stocks, and we think that if anything should happen unexpected in the Middle East, that oil prices will go over 80, might even go to 100. So we think that the group is de-risked. There's not much, war premium in the price of crude right now, and I'm not sure what people are looking at really. But if you look at the inventory of crude oil in the United States, it's back down to basically a low that hasn't occurred since 1985. So provide this information that we look at is correct, right? Oil prices are set to go higher, and that's probably a really good indicator for the stock prices. However, the stocks we buy, we don't want to be dependent upon the price of oil necessarily, but for them to have a nice move even without oil going up. So we've talked about the government spending being such a large part of the growth of the economy. And what we did is we pulled out the real retail sales and food services sales. So what that is you take the nominal sales, so that's real and inflation, so what's happening at the retail level, and you pull out the inflation, and you see what the real sales are. So that's what goes into GDP, is the real growth. And you can see from April of 2021 that we haven't made any sort of improvement at all in real retail sales. So this is what's the real complaint from consumers, is they're not getting anywhere. They're actually down in their real spending. So this is an election problem as well. So we think that if you pull out 5 or 10% of the spending of the government or more, you're going to see negative GDP growth, which will actually be a real benefit to the economy, which will allow the private side of the economy to grow. So longer term, it's a big positive if that would occur. In terms of wealth management, so as we discussed, the price target of 8,000, you could argue with that, but it's generally in the ballpark. We think we'll see some earnings growth and maybe the valuations to contract a little bit. That's what that 8,000 is based on. And to get a 10% return on your equities, otherwise it's not worth doing if you're not going to get 10% return or take a really low risk profile in your equities. But 10% return in the overall markets is a reasonable thing to expect. With a 15% sort of standard deviation, we need we need the markets to pull back at least 15% to get a reasonable rate of return of that 10%. So to account for the risk in the overall market, we need a nice pullback to occur. So we think the way to play this is with growth in income stocks, growth at a reasonable price, um, type of securities, and then take advantage of the volatility. The biotech stocks look really good to us as well, but take advantage of that of these stocks now, while rates are still somewhat elevated. Maybe rates will come down, and if they don't, then we're okay as well. But buying these higher dividend paying stocks makes a lot of sense. If you can get 6% on a dividend paying stocks, that's really compelling. Now, NEOS has a S&P 500 high income security, so it tracks, correlates highly with the S&P 500. And a really strong move up, it's going to lag, and a move down, it's going to fall as much as the S&P. But you're going to get 10 to maybe 12% sort of yields off that security. So it's a security that uses options. They write a lot of options, and you get really nice rates of income off of that security. So that's one way to play the S&P 500. You'll get a significant amount of the movement up in the S&P 500, but you also get that beautiful income coming in. So if the market drops 12%, you hold this for a year, you're going to be roughly flat because the income is going to offset the decline. If you just own the S&P 500, you're off 11% roughly in that position. So we think this is a really good way of investing. If we have a melt up, you're going to make money, and if we don't have a melt up, the market just goes sideways, you're going to make a nice rate of return. So here's a trade, right? CrowdStrike, we always admired this company. It got to $400 roughly, and then they stubbed their toe in a big way with that software conversion, and the stock went from 400 to roughly 200. Okay, so we love buying stocks that stubbed their toe. The last good one we had was Raytheon, if you remember that one. They had the issue with their commercial business, aerospace business. The stock fell, about 30% or so to 80 or less. Now it's 120 or better. So it's had a 50% move. High quality company, big move. We think CrowdStrike did the same thing. Went from 200 now over $300 a share. We bought it opportunistically for one of our strategies, thinking, okay, 300 is good enough. It's a highly valued stock. There's a lot of competition in the sector. Why don't we move out of it and go into ASML? This company virtually doesn't have any competition. They focus on capital equipment for high-end production of semiconductors. So those really high-end chips, these guys provide the equipment to do it. And as we get more and more complex in our computing and artificial intelligence, more and more, will be demanded out of ASML. So a lot of demand is probably expected to occur in the next 5 or 10 years for this company. We like this one a lot. Came down from 44 times earnings to around 27 times earnings. So they had a little bit slowing of growth. We think it's a really good security to own for the long term. And if the market continues to go up, this is going to do really well. So we like this one a lot. So one more thing we have coming soon, besides the election, right? Election's in 3 weeks. So that's a risk to the overall markets. But we have a really interesting company, DERM, D-E-R-M, Journey Medical. They have their approval date on November 4th. We think there's a really nice upside in that stock. And then FBIO, which is really undervalued, as they own 50% of DERM. So if you do the math on that, plus a bunch of other stuff, this is a really compelling stock as well at FBIO. So again, we're wondering about a melt up in the overall markets. We'd like to see a correction. If the markets go up it's going to be ugly probably next year. Um, and then the way to play this is through higher dividend paying stocks, growth at a reasonable price type of stocks, good quality blue chip companies. SPYI is an idea of ours. So if you have any questions, ping me or come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. We'll send that to you every week. Take care.